This is Sovereign Debt, a podcast on greening the global economy and debt sustainability. I'm your host, Jill Doshi. Hello, everyone. I hope you enjoyed listening, or rather re-listening, to Ambassador Wisner last week. And even though we taped it back in November, his views on the changing global order are even more relevant given the war in Ukraine and shifting power structures worldwide. So I hope it was useful. But today, I'm very excited to introduce Ekaterina Gratcheva. I met Katya a few years ago through friends at the World Bank. And since that time, she's been on an incredible journey of change and research. And Katya is now the lead finance officer of the Climate Investment Funds and brings together a perspective of an investment practitioner and, importantly, a thought leader on sustainable finance. So Katya, thank you so much for being with us today.
Thanks, Jill. And it's really an honor to be here with you on the podcast. And thanks for being part of my journey. You've been quite a big part of it. And I enjoy listening to your podcast. I think it brings together very interesting perspectives. So I'm happy to be here.
Great. So before we get into it, could you please give all of our listeners an introduction and tell us more about the Climate Investment Fund?
When I moved from mainstream investment industry to climate investment funds, I was really impressed what it is. And at the same time was surprised that it's so little known in the mainstream finance. Yet at the same time, it's a very effective mechanism, one of the largest multilateral funds to help emerging market countries with their low energy transition. It was established in 2008 under US leadership and G8 at the time, also at the time of the global financial crisis when the emerging market countries were struggling with the access to capital. And the G8 countries and other contributors have capitalized to what is now a $10 billion fund. And it implements exclusively through 6 AAA-rated multilateral development banks, which includes World Bank, IFC, African Development Bank, Inter-American Development Bank, Asian Development Bank, through both their public arms and private sector arms. And we're going into catalytic projects that otherwise would not happen because our objective is to not only help countries to transition, but through demonstration effects to catalyze new investments and catalyze new capital markets as well, which we've been demonstrating for the last decades or so.
So a country or a project in a country that is working on transition in the climate space would come to the climate investment funds, or they originally go to one of these implementing partners first, and then they apply to the funds?
We are a programmatic fund. That means which we approve specific priorities where we will be financing countries, for example, like renewable energy or energy integration, or more recently, accelerating coal transition. And countries would be able to apply for this process through those windows for concessional funding. Implementation happens through one of those tools or a combination of multilateral development banks that help them put together investment plans and implement those projects. So we work through both contributors on the priorities for what they see as the highest impact, given their objectives, and with MDBs based on their relationship with the countries and how they see what is feasible on the ground.
And when you say they're catalytic funds, does that mean you're providing credit enhancements or guarantees or something so that the private sector follows, or are you just investing alongside private sector?
We are a catalytic fund and we are blended finance fund, which means we provide concessional funding, but it could come in any form, from grants to concessional loans to equity to guarantee instruments. And we target to maximize participation of other co-financiers. And our track record for each $1 in SIF capital, we bring in $8 of other capital. That would include private sector, multilateral, bilateral, and other sources of finance. So we're looking for two, if you will, KPIs, both the impact in terms of impact on climate and transition, and second, in terms of how much additional capital we can bring. And so with that, we were able to bring in now 65 billion in total capital in developing countries.
So thank you so much, Katja, for that. I think the work at SIF is just incredibly interesting. But I also wanted to turn to your work that you had been doing, your research work at the World Bank, and in particular, the very important work that your team did on ESG scoring and the income bias. Can you share us some more information about that research?
Thanks for this question. And in fact, it's that research that brought me to climate investment funds to be able to actually apply those findings that we're going to discuss right now. And everybody is probably now quite familiar with the terminology of ESG. They became such prominent in the financial industry, but very not all are aware that sovereign ESG is a very recent phenomenon that has only become started to gain traction in the last few years. And we were at the center of it. And in fact, pretty much because of the lockdown, we were able to do some serious thinking and deep analysis to understand this sovereign ESG. And why was this quite an important research and its findings? By the time we started looking into it, the corporate ESG world has gotten sort of the common understanding of what was called as aggregate confusion, where leading ESG data providers and ESG scorers were found to score different corporates very differently. And it became a part of the discussion, is this the right way to do it? And what is the source for this? And how to deal with the fact that there is no consensus of how to rate corporations on the ESG metrics. We were quite curious because then those findings started to be automatically applied in relations to sovereigns. And we had the hunch that perhaps in sovereign space, those findings would not necessarily apply. So at the start of the lockdown, we reached out to ESG data providers who were very generous with us and provided us with the sovereign ESG scores. And we started looking at them. And this was 7 providers, so the leading ones, including Sustainalytics, MSCI, Robeco, ISS, FTSE Russell, and a few others. I'm probably missing a couple. And we started to see that their sovereign scores, ESG scores, are highly correlated, which was contrary to what the industry saw in the corporate ESG scores. And we started to see what are the root causes of that. And we found in particular that despite all of the different efforts to differentiate ESG measurement across different sovereigns, they all use the same data source, and all of the data are subject to what we called ingrained income bias, meaning that 90% of all of the ESG scores, if not more, can be explained by the country's level of development, meaning that you can use country GDP, and that would be just as good as a proxy as a sovereign ESG score when you're trying to analyze the countries. That certainly was an important finding that revealed some shortcomings in blindly applying sovereign ESG products in investment analysis. The other important finding for us was that there was quite a conflation of application of ESG as an input into the investment process to manage portfolio risk, as well as expectation that that will lead to ESG impact, ESG as an output. And we found that this is quite 2 different things. And ESG as an input does not lead to the ESG impacts. And that's also started the conversations of how, in particular with the SFDR regulation for Article 9, what needs to be done in order to move from ESG integration into more ESG impacts, and whether there are any relevant investment products that investors could utilize to comply with the impact. And what we've been seeing in our discussions with investor management, there was more and more growing interest in seeing the real life impact from the investment. So that became quite a start to conversations that we've started having with investment management and other partners.
And I want to come back to this ESG as an input, as ESG as an output. But first, what you're saying is that they were just, as the industry kind of evolved, there was this tendency to just take what we were using in corporate kind of thinking and just applying it to sovereigns without really taking into consideration the particular natures of a sovereign issuer.
That's correct. Mm-hmm.
Right. And then when you're saying the ESG as an input versus ESG as an output, can I just kind of drill down a little bit and make sure we're all understanding what you're meaning by that? Are you saying that ESG is an input, that you are kind of weeding out certain countries or scoring them based on their performance of ESG and assuming, or was that the assumption that those that were performing well going in would be having the most impact? Is that what you're saying? The ESG output?
That's right. So when we were talking to investment managers, and they were believing that if they worry about environment or environmental risks, and they use that to adjust, let's say, the weights in the portfolios or select the investments in particular countries, that choice that would help them manage the risk of their portfolio, of their financial assets, would lead to somehow that translating into impact. Let's say if you include E, or in your environmental pillar specific metrics into your portfolio decision making, that you are, by doing this, influencing the performance of those environmental, let's say, factors on the ground. And country would be incentivized to improve on these policies on whatever particular impact you are concerned about in managing your portfolio risks.
And you found that wasn't necessarily the case?
It's definitely not the case. It perhaps serves the interest of the investment manager and improves their risk numbers. It's not the same as country achieving impact on various policies.
Okay, and so that had a particular impact on the investment industry and the particular recipient countries.
Well, in the recipient countries setting, I think what became clear from our analysis is that if investors are blindly applying sovereign ESG score in their selection criteria or in their decision making, they are overweighting wealthier countries at the expense of the lower income countries. For example, JP Morgan Emerging Market Bond Index is its ESG equivalent is 11% wealthier than its non-ESG equivalent, which basically misallocates capital away from low-income countries just because they are poorer, not necessarily because they have worse ESG performance. And that's purely because they're rated lower on ESG, it has very little correspondence to the ESG impacts.
In other words, the income of a country greatly affects its ESG score. So the wealthier countries have better, the way the ESG is measured, it favors wealthier countries.
That's right. 90% of all ESG scores across all of the providers is explained by the country's income. And 10% of this is noise. We haven't been able to identify any other parameters that would explain the 10%, just a measurement error.
And why is that? Because if anything, it's the wealthier countries that are the bigger polluters, or is there something else at play?
Exactly. And I think that's the questions we started asking that led us into other research areas where we tried to identify how to actually strip this income impact from ESG impact. Because basically, in other words, what this findings means is the macro and fiscal factors, which is a proxy for the country's GDP, is dominating the decision on ESG score and ESG integration. And that means it masks any materiality that could come from any other factors that are not linked to macro or fiscal parameters. And that's, for example, we found this when we started to look at the country's national wealth. That would include also natural capital, human capital, that are not financial aspects of wealth. And we realized that without adjusting for income, you wouldn't be able to find materiality of importance of good management of natural capital, especially for low-income countries, because you just, those factors in regular ESG analysis would be immaterial, which means they would be excluded from consideration. And that's perhaps not the right way of making the decision on whether to invest and how to invest in a particular country if you want to emphasize importance of good management of natural capital, especially since the low-income countries, they are by far the largest portion of the national wealth, which is very different than for developed countries where it's produced capital and human capital that dominate that.
Exactly. So this is kind of just an issue within the international financial architecture just generally, is that these low-income countries are actually stewards of this natural capital and this wealth that is critical to the entire planet. And yet our financial systems don't actually help investment flow to those countries. And even for ESG investors, what you're saying, even for ESG investors who could have raised their hand and said, these issues are important to me, even in that case, or even more in that case, you're saying the scoring systems and the methodologies take them away from those emerging markets.
Exactly right. And we found that there was such a pressure to be seen applying ESG that there was very little critical thinking or evaluation or looking under the hood of what goes into those ESG scores to actually come to that conclusion. And we were able to change that conversation where we're now quite aware that this raised important questions and quite a few investors are started to look at this issue to see how they can deal with this in application of their own portfolios.
What are the practical ways that these issues can be addressed? This issue of income bias can be addressed, and in order to help countries access that capital for their needs. I mean, is there ways that we can fix it?
Well, as you said, this is sort of an inherent feature of the current financial architecture. So what we're working within that architecture to see how we can find some patches to fix some of the problems. And I can talk to maybe a couple of ways one can think about it. One, definitely on the methodologies, right? So the investors that are able to start putting a little bit more effort into understanding the implications of their investment decisions. And if they are particularly looking for impact, they would need to have a much more robust way of distilling the real impact from the sort of just greenwashing, if you will, and more efforts are on the way for that. But there is also then the issue that emerging markets are getting penalized as a result of the current financial architecture. That issue can only be addressed as to help them to access capital markets. And for example, in the climate investment funds in particular, we are working through addressing some of this risk and providing concessional funding that will be able to make their project commercially viable to attract private capital. But there is also quite a lot of discussion, and I know you are part of these conversations, of how to change bond instruments and financial instruments that would be able to bring together interested investors and issuers so that they are having sort of KPI linked instruments that are achieving particular impacts on the ground, whether it's in the nature space or the sustainability issues.
No, absolutely. And for the lower rated countries or the lower income countries.
In particular.
Mm-hmm. Yeah, exactly. And then for yet still needing some sort of element of either blended finance or credit enhancement or support.
But I think this is an important issue, Jill, on what we've been seeing in the ESG space, this discussion doing well and doing good that ESG pays. The reality is, if you do ESG as an impact, there is a trade-off. There is needs to be, if you pursue non-financial objectives, then for the impact, you have to be able to sacrifice some of the returns. And we are seeing that there is lack of willingness on the investor community to give up some of that return. And without sort of concessionality instruments, without somebody coming into the middle to compensate investors for their interest in impact and for emerging markets to come to the market for the impact, those instruments have not been yet mainstreamed.
No, but and this is the elusive greenium, right? We're still kind of chasing it and trying to use, in some ways, again, this kind of blended finance or other mechanisms in order to start the system, to unblock it, to get people thinking along these in these ways. And then I think the hope is that then the markets will grow and start to realize that these non-financial outcomes are important. But you're right. I don't think we're quite there yet.
That's right. And for the greenium, perhaps there is a mixed evidence for greenium at the corporate sector. There is no clear evidence at the sovereign space. So the investors are not willing to pay for sustainability.
Well, and then when you add on to it that they're going into, if we are trying to get them into these, more challenging environments, that the credit rating scores and everything else are kind of working against us as well. So it is certainly a challenge. But all of this kind of leads me to some of your current analysis that you've let me take a peek at, and we've been discussing about the critical role of human rights in sovereign ESG, particularly as we move forward. And as you know, part of this work for me, I have to admit, is a walk down memory lane. In that university, I was a student of Russian language and literature and history and politics. And in the 80s and 90s, that certainly meant also a student of human rights. So I really loved learning about your current analysis and current work around these issues, and starting to kind of connect the dots between today's conversation of ESG into this much longer history of human rights. And all of this kind of in this global context of the sustainable development goals and all of that, it's so poignant in today's context of what's going on in the world, and particularly with the war in Ukraine. So can you tell us a little bit more about your current work around looking at this role of human rights and the interplay with ESG.
Indeed. Current events really shocked the system, and it touched me in a personal way as well. But if we put the human tragedy aside, I think right now it's really an interesting time when investors are looking even more closely at ESG, because quite a lot of them got caught in this event and found themselves exposed both in the financial level, because Russian sovereign bonds went pretty much to zero very quickly, but also being exposed from the reputational perspective of having been invested there in the first place. But our foray into human rights really is coincidental, because we gotten into topic of economic and social rights a few months back in the fall, when we are in search of trying to identify the root causes of sustainability within countries, as we discussed, to go beyond GDP and macro fiscal aspects that lead to ingrained income bias. And we found a human rights measurement initiative that in fact has been looking at quantifying economic and social rights, which are quite distinct from civil and political rights that perhaps are very top of mind for a lot of people now with the war in Ukraine.
And so you stumbled upon research that was already being done on the human rights in trying to link.
We stumbled on the data set for the economic and social right that's basically quantified at each country level their performance in the economic and social rights, and it scored countries based on their achievement on economic and social rights without looking at political rights.
When you say economic and social rights, what exactly are you meaning? Is that like access to the financial system?
To health, access to food, to shelter, to education. It's basically all of those enabling environment for individuals to develop and grow and aspire to lead in dignified and fulfilling lives.
Okay, so these are very, very basic rights. It's not like access to like mobile banking or something.
No, it's very basic. It's fundamental, and it's really is from the Universal Declaration of Human Rights that actually was put together after the previous World War and World War II. That really established the basic necessity and the universality of human access to education, food, health, housing, work. And then political and civil rights of self-expression and all of the other ones. So there has been quite a lot of work that established that those economic and social rights are linked with economic performance in countries over the long term. So that was quite an interesting segue for us to start looking at it from the perspective of the bond investor to see if that data set helps us to move beyond ingrained income bias into distilling countries' performance. And in fact, that we had very good results that we are looking to publish, and you had a sneak peek at. And for example, while I mentioned that sovereign ESG scores are 90% explained by country's income, only 25% of ESR, economic and social rights scores, are explained by income. That means 75% is really measuring various aspects of performance aspect of countries.
So then even a low income country, a poor country could be scoring well in performance on
exactly,
and
high income countries are not necessarily going to be scoring very highly. So the score is from 0 to 100, and you would have quite a full range of performances across the country income level. And if you plot all of those performance countries, you see sort of a frontier, not very different than Markowitz's optimization frontier, where you can see where the top performing countries are in each of the countries' income level. And we were able to use that data set to test some of the investment strategies that we know are being considered by investment industry in, for example, tilting their bond portfolio or making decision on exclusion of particular countries from consideration. So that's what we're demonstrating in our paper in a quantitative way using the data set. And we found that perhaps this data set is the best data set that has been able to address the income bias in how they put the data together.
So in the whole human rights, we've got normally the economic and social rights. That's what you're talking about now, in terms of the basic economic, shelter, school, food, etc. And then we have your civil political rights. And that's what we think of when we think of elections, free and fair elections, or other, the right to assemble or fair judges, right? So when we think of ESG and the G in the governance, or maybe help me out here, like I'm just now realizing that maybe I'm a bit confused, but where is the human rights in either category really currently showing up in ESG, or is it not? We're really thinking of impact. Does that make sense?
It's a good question, and we are starting to think through this. But just to help you out on the civil and political rights, so it's the freedom from arbitrary arrest, freedom for forced disappearance, freedom from the death penalty, freedom from extrajudicial execution, freedom from torture and ill treatment, right to assembly and association, right to opinion and expression, right to participate in government. Where economic and social rights is right to education, to food, to health, housing, and work.
So that doesn't actually track perfectly to ESG anyway, right?
It's not, but you also have to think of ESG as not encompassed and not exclusive. And in fact, I always ask, why is it ESG? Right?
Obviously, yeah, exactly. I guess that's where I'm going with this, is that ESG is a little strange because we're talking about environmental, social, and governance impact.
If you have to map the human rights, clearly the political rights would get into S and G, but so is economic and social rights, right? They would get G's underline all of those investments just because of the policy, performance, and governance, etc. But it's not a total overlap between human rights and ESG, and we are just looking at different ways of how to extract the sustainability measurement for sovereign debt. Clearly, what has been done in sovereign ESG hasn't really worked well. And if the objectives of the investment community is to move towards more of an impact investment, that the way sovereign ESG industry has evolved perhaps doesn't have the solutions that we're seeking. So we have the luxury to think outside of the box and see what actually can be used to address these sorts of things. And for us, economic and social rights. And I guess to me, if you think of Amartya Sen, the Nobel laureate in economics, and his development as freedom, and all the empirical studies that show that sort of respect for and realization of different human rights, economic and social in particular, enabled by political and social rights and political and civil rights, is really both a means to a development journey as well as an end in itself, right? I think it's the whole story of is growing GDP is the only path to prosperity, and dignified life. And one could think of human rights as not only means to development, but it can also be an end in itself that enables life with dignity across all income levels and ability to realize, regardless of where you're born and where you start your journey. So it's an interesting question that we perhaps can pick up with our team and think a little bit more. But we had a very useful ESG framing for us and income bias and addressing income bias to help us guide our empirical analysis. But this is just beginning of our journey, because our objective is how do we bring more impactful instruments and channel capital toward more productive and impactful opportunities, because it's not happening, as you said, with the current methods, tools, and how the financial architecture is designed.
Right. So it might just be, some basic flaws. I mean, as you've pointed out in all of these various research pieces, there are flaws in the actual kind of fundamentals of ESG, of the definitions of it, of how we're kind of thinking about it.
And we don't want to throw baby with the bathwater. So we are working with what we have, right? And we're trying to find solutions and move this forward. I think this was a very important starting point to introduce ESG. When I started on the trading floor at the late 90s, nobody on the Wall Street would be thinking about sustainability or using this terminology. Anytime you call them from the World Bank, they would roll their eyes and think you're a tree hugger. And now the terminology, whether you're in the World Bank or in investment community, is very much aligned. And I think this is a huge journey for the financial industry. And we just want to steer it towards continuing this improvement. And as we understand more with our empirical analysis, we want to advance this discussion. Our team is clearly in the evidence-based space rather than in the advocacy space, where we work within the current system to identify ways and methods to improve it. And in my role in climate investment funds, it also helps you to think through financial instruments and ways to improve our mobilization and direct capital for low carbon transition and just transition. But that's a conversation for a whole other podcast or two, because I think we have to be creative. We have to be thinking a little bit more. And now I have the luxury of doing it both at sort of research and analytical level, and have the opportunity to apply it at climate investment funds. And I'm engaged with our shareholders, which are our contributors, as well as with the investment industry to think through all of this and find solutions.
That makes a lot of sense. And I like the way you put it. So as a closing thought, what advice would you give to these investors? Because you rightly say that this is now, the ideas of sustainability and impact are now becoming more and more mainstream, really. And that's a push from the retail side as well as the institutional side. So for investors who are wanting to make an impact, what are your advice to them for finding products that they can really believe in? And then, not to make the question too vast, but what about the sovereigns and the debt management offices and the governments who are actually looking to issue these sorts of instruments? What advice can you give to either the investor or the issuer?
I'm now in a very good position of seeing how the investor community is looking at this thing, and also how developing countries. And what I see from my vantage point is I see plenty of capital looking for investment opportunities and for impactful opportunities, and a lot of goodwill. And then I see a lot of need for very good transformative investments in emerging market countries. And I see the two sides moving closer together. And there is the likes of yourself and your company and lots of other people who are helping to build the bridges. So I think from the investor community, we talked a little bit, is to really be very purposeful in looking under the hood and be very looking under the hood at how you're making those decisions and have clear ways and clear targets on what you're trying to accomplish, but also be willing to engage and be open-minded in how you look at the opportunities. On the developing countries, there is a lot to be said, and I know you help in sovereigns in understanding how the market is evolving, how there is this demand for better ESG performance, and they can start taking even small steps through the DMO offices, debt management offices, to increase awareness of what they're doing, because quite often they're so busy with just running the day-to-day operation and managing the sovereign debt and cash flows. So for the sovereign, they wouldn't even have a website where they can start putting all of the good work that they're putting together, just because they are public servants. They are quite often short of resources. And what we're hearing from those sovereigns that have gone to the markets, whether it's Egypt or Benin, and you've had them on your podcast, that it requires a lot of investment into upskilling and uptooling the finance ministry and that management office to be able to take advantage of how the financial system is evolved. So I think it takes all sides to really take a step closer to the other one and to understand perspectives, to start building those bridges between sort of supply of capital that's willing to go and the demand for that capital, and help investors, help countries with those investment opportunities.
Well, thank you so much, Katya. And the only thing I would add is that they should, as a first step, read all of your papers, because I think they're really eye-opening and thought-provoking, and like you say, help to look under the hood and not take things at face value, and to really be driven by the data. So thank you so much for your research, and good luck with continuing it. We look forward to all that's coming.
Thanks, Jill.
Thanks for listening. If you enjoyed the episode, leave us a review and subscribe to the show wherever you get your podcasts.